What's going on, guys? We are back with another Alibaba video, and this is going to be a good one. We had a lot of comments on the last video that talked about the decline in China and basically Alibaba as a business. And I want to go over a couple of those here in this video. I want to talk about the cloud business. I want to talk about the revenue situation that's going on in China with Alibaba, with Tencent. Take a look at both of those. And then I want to get into some of the stuff that's actually happening and happened over the last couple of weeks that's going to impact this into the future. And we're going to finish off the video by talking about something very interesting. We have one of the top investors in China basically getting out of all of his positions in China. He has gone from the ultimate bull on China basically to the ultimate bear just in the last month, and it's absolutely an insane flip. So we are going to go over that investor at the very end and touch on some of their talking points and kind of my rebuttals to them. So overall, I hope you enjoy the video. If you do, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. So today we had an amazing green day for Baba. So this felt so good. We have had a lot of red days recently. And finally, we were up kind of throughout the day. It was hovering around 3%. And I was kind of watching it and I was like, oh, this is an awesome move. So it just really spiked up in the morning and then leveled off throughout the day. So we were up 2.99% on the day, another little bit after hours. Over the last 5 days, we're up 2.74%. Last month, not feeling so good. We're down 8.45%. Last 6 months, we've kind of, you can kind of see it's almost traded sideways, but it is down almost 15%. It just looks sideways. So we are down from 107.94 all the way to 92.52 where we're at right now. But we've had a lot of dips in here and a lot of spikes back up. So overall, not really looking good. If we zoom again back all the way out to the last year, we're down 45%. So Alibaba has clearly been beaten down quite a bit. And we're just maybe hopefully turning a corner to start, some recovery. It's never good when you see businesses talking about headcount reductions, cost cutting, things like that. That is always a sign that a business seems to be in a little bit of trouble. And here we have Alibaba and Tencent executives have been focusing on cost cutting across the business from headcount to existing non-core businesses. It comes after Alibaba and Tencent both posted a set of second quarter results that confirmed these once freewheeling and high-flying behemoths are not growing anymore. So again, that's absolutely a terrible thing to hear is, hey, these companies are no longer growing anymore. And now they're looking at how do we cut some of these costs? How do we cut these non-core businesses? Which non-core businesses, again, that's something important to remember is a lot of companies, if they had something that they saw as a growth vector and it really hasn't established, it hasn't gotten its feet underneath it, it's still a liability to the business. They're going to reduce how much funding they put towards it, to reduce that liability that they have going on there. And for headcount reduction, that's not always a terrible thing. We've gone through a lot of a very high growth period, and a lot of companies have looked at, oh, we could use someone here. Oh, we'd like to have a position here. And as that happens, right, they tend to fill those positions up with basically what can be non-necessary positions. And over time, as the economy kind of cycles back and we have a little bit of a downturn, then those positions become, less needed and the company becomes more focused on leaning down, becoming more profitable or trying to become basically profitable, stay profitable, whatever it may be. And what they'll do is they'll scale back on a lot of those positions. So it's a healthy kind of nature of how things work, where a business will, go through that hiring period, go through a lot of growth, and then, focus on leaning down and staying lean for a short period of time. And then, use those lean, efficient employees again to accelerate their growth on the back end, of a downturn. So overall, headcount reduction, in my opinion, not completely a negative thing. Obviously, people losing their jobs, not a great thing going on, but for the company overall, I personally think it's kind of a good thing going forward for the long term. I mentioned this earlier, but big tech in China suffered, and really all of China suffered. So China's biggest e-com player, Alibaba, reported flat growth for the first time ever for its April to June quarter. And then on Wednesday, gaming and social media giant Tencent posted its first ever quarterly year-over-year revenue decline. So Tencent had a really bad earnings report where revenue declined. I think it was by like $20 billion. It was something absolutely insane. Alibaba was basically flat. I think they had a small decline of revenue of like 0.1%. So nothing crazy. But what you have to remember, and what we'll kind of look at here again, and even mentioned right here, is these companies are suffering, and the economy in China and a lot of cities in China have gone through a very fluctuated period of time where they will be shut down for weeks, months, whatever it may be, until they kind of get the pandemic under control in that city, and cases fall off. And the China government has had a zero tolerance policy on the pandemic, so they've continued to shut down cities and shut down different areas, where Alibaba, where Tencent are doing business. And when you have that, it's going to be very difficult for companies to grow. It's kind of like what we saw back in 2020 when a lot of companies had poor earnings, poor revenue for that quarter immediately after kind of some of the shutdowns and lockdowns. And then after that, after all the money got pumped into the economy, we started seeing things take off again. So let's go ahead and actually get into something that is very interesting that plays right into that point. August 15th, the Chinese central bank actually trimmed their interest rate. So that was the first kind of trim that they had. So the central bank trimmed its short-term bank lending rate to 2% from 2.1%. So nothing overly significant. And its one-year lending rate to 2.75% from 2.85%. So they're doing small adjustments here. So that's one adjustment down, right? They knew the data was going to be bad. They adjusted down just a little bit for their interest rates. But then this Monday, which was August 22nd, China actually trimmed their interest rate again. So in efforts to boost its economy, the People's Bank of China lowered its 5-year loan prime rate from 4.45% to 4.3%. So again, a 0.15% decrease. So nothing super significant. And it also reduced its 1-year loan prime rate from 3.7% to 3.65%. So across the board, and they can basically, the Chinese National Bank, People's Bank of China, they keep reducing their interest rates. And what we saw, if you remember, right, back in 2020, the US, the Fed, they decreased interest rates, and we saw money become more freely available. And what does that mean for companies, especially big tech companies, is that they have more money to spend. And what we're talking about, I highlighted here, is right, so lower interest rates tend to favor high growth tech stocks because they can boost their earning power and make cost of doing business cheaper. So basically they can loan or borrow more money to use to propel their business forward, right? For any growth ventures that they have going on, anything like that. Basically they can grow quicker and earn more money. So overall, again, this is a huge positive thing. What would be very interesting to see out of China is if they did some sort of, stimulus to re-stimulate or attempt to re-stimulate their economy, because that is where they're seeing the big pain basically in China. Is their GDP growth has been absolutely terrible from what they've projected. It's been way lower than people have thought. And that's where the People's Bank of China is getting concerned. They're starting to see these regressions in their GDP growth, and they're really wanting to turn that around. And that's only going to benefit a big tech company like Alibaba in China. The last thing I wanted to go over in this video is this man right here with this video. And this video is The Changing World Order by Ray Dalio. And I'll let it play in the background. But this video has almost 20 million views. And Ray Dalio in it talks about how China is overtaking the US as the global leader, basically in terms of its economic power and its influence over the world. And he goes over how, basically China is reaching in, has better schooling, better systems in place, and will potentially become the reserve currency of the world. And he talks about how that's helped the US basically build its economy and how that'll help China grow its economy. But what's very interesting is this was only posted back in March 2nd of 2022. So only a little over 5 months ago. And now Ray Dalio has flipped the script and sold out of his Alibaba position. And in my opinion, I think he is wrong on both of these fronts. I think he is wrong that the US is going to lose its leadership to China. And I think he's also wrong in selling his Alibaba position. I think the US has kind of proven over time, continually over time, that it is the number one leader. And you hear from a lot of foreign basically investors that the best place to invest is in the US. And they keep putting money in the US and everything like that. The US is just going through a small downturn. And when he was looking, during March 2nd, this was kind of the peak of everything going wrong, right? Oil prices were skyrocketing. The US had lost a lot of leverage in positions, but now we're kind of getting, through a lot of those worries. And we're starting to get to, starting to see the light at the end of the tunnel, at least a little bit, as inflation, has started to sneak down just a little bit. Some of these other things, that were just continuing to go up back in March. So as that has changed, I think Ray Dalio's opinion has probably changed, right? The US is probably, back on top. But the other thing is Ray Dalio sold his position in Alibaba. And I think, in my opinion, that he was wrong in doing this as well. Because I personally believe that over time, yes, China may be going through a hard period of time. And we haven't even gotten into any of it, but the mortgage crisis that's going on in China, there's plenty of good videos out there. You can look it up, but there's a lot of issues going on there. And the only thing I can think of is maybe Ray Dalio sees that mortgage crisis turning into something like 2008 in the US and thinks there's going to be a better opportunity in the near future to buy back into China. But if that's not the case, China has, the number one population in the world. They continue to grow their businesses. They have had hard government policies in place that have made it difficult for businesses to grow in the short term. But as they go through a difficult period of time, right, as the economy gets weaker in China, what will tend to happen, or what I would expect to happen, is that the Chinese government tends to pull back on a lot of those restrictions. So instead of, regulating a lot of these tech businesses, levying fines against a lot of these tech businesses, they will instead, pull back against some of their, previous dispositions of, fining tech companies and things like that, and instead focus on how do we help these companies grow? Because when you help these companies grow, China GDP will grow, people will be happier in China. It just is cyclical. It's a cycle that will just overall help the Chinese economy. So I think right now, China's going through and is going to continue to go through a tough spot, but they're already showing through lowering interest rates that they're willing to do the necessary steps to help their businesses grow. So again, this is just my opinion. Obviously, Ray Dalio, he actually has spent time in China. He knows a lot of Chinese leaders. He knows US leaders. Maybe he knows something that I don't. But in my opinion, over time, these things will play out. And I still think the US is the number one leader in the world. And I still think, China has the ability to grow. I don't think those things have to be, exclusive, one or the other. So I hope you enjoyed the video. If you did, make sure you drop a like down below. We've gone over a lot of hot topics in this video. So if you, let me know your opinion down in the comment section. I love to hear it. Again, everything in this video is my opinion. I personally do own Alibaba shares. So I tend to be, more bullish on it. I hope the company goes up. But again, if you like the video, make sure you drop a like down below. If you want to see more videos like this one, make sure you hit that sub button. And as always, have a wonderful rest of your day.